Today we're going to talk about our outlook for 2022. We're overall positive on the markets in 2022. We do expect more volatility as liquidity is withdrawn as the Fed raises rates. We expect lower returns, but still solid returns supported by the economy and strong earnings. Within fixed income, we're likely to see negative returns, particularly in the treasury market and other high quality areas, and more muted returns in credit and investment grade corporates and areas like that. You also are likely to see negative real returns. And by that, I mean that particularly parts of the fixed income market are not going to keep up with inflation, which is running presently at about 7% a year. So stepping back, we're on this transition to normal, and we're not quite there, but we're likely to get closer there. It's going to be a little bit choppier and harder market with more volatility as the Fed starts raising rates. And the markets are going to really have to learn kind of to swim on their own. There's going to be fewer tailwinds, and what that means is the fundamentals are going to matter more. But the economy is solid. If you look at consumer savings, they're very strong. They're also high net worth. And businesses are in really good shape. The margins are strong, earnings are strong, their balance sheets are solid. And we're also transitioning from what has been a pandemic ultimately and hopefully to kind of an endemic COVID situation. By that, we learn to live with it. You've got higher vaccination rates, immunity, and antivirals coming on the market. There are still risks to this market. COVID, you could get a new mutation. Some of the highest risks this year are going to be rates and inflation. Growth is going to be slowing, particularly in China, and that poses a risk to global growth. But bear markets are very rare outside of recessions, and we don't expect that to happen. Equity valuations are high, and that's an issue, but valuations really don't drive markets in the short term. And what's the alternative? If you have muted fixed income returns, investors really need to be in equities. If you look at our view of the markets right now, in the snapshot, we're overweight equities. Particularly, we're overweight domestic versus international and underweight emerging markets. And within fixed income, we expect rates to go up. So we prefer credit risk over duration risk. By that, I mean interest rate risk. So we avoid interest rate sensitive areas or we're underweight them. And overall, we expect lower quality to do better within fixed income areas like high yield and leveraged loans. And so I'm going to turn to the economy now, and we've had this shorter and faster cycle. In a way, it's very unique in that the economy didn't turn down because of excesses in one area, like the housing market before. So it's been a very compressed cycle, and we're likely to see that continue. Right now we're mid-cycle, moving a little bit closer to late cycle. But this is an environment that supports equities. So what do we expect for growth? We expect slower growth. In 2021, it should come out around 5.5%. 2022, somewhere around 4.5%, and then closer to 3 or under 3 in 2023. So still very, very solid growth. There's a lot of pent-up demand, particularly within services. The consumer is in very solid shape. There's about $3.5 trillion in checkable deposits. High net worth is supported by equity markets, so people are feeling good, and solid employment is another aspect of it. Wages are rising because the labor market is very tight. So all of this supports a strong consumer market. And then the other side of the equation is that businesses are in really good shape. Earnings are strong, their balance sheets are good. We expect a longer term investment cycle that's starting and should extend for years, in particular increase CapEx. And part of that is driven by onshoring. Companies saw what happens when supply chains get disrupted, and they want to onshore more of that, and also trade disputes with China is another thing driving that. And then you have this ongoing secular trend of kind of technology diffusing throughout the economy. The biggest issue this year with the economy will be inflation. It's higher than it's been in decades. And that's been a factor of this unprecedented stimulus that's been thrown at the economy, both fiscal and extremely accommodated monetary policy. So you've had demand outstrip supply, and that's created supply shortages. And that in turn has driven inflation higher. And the economy right now is running close to or at capacity, which also tends to drive inflation. So our forecast looking at this year is that inflation will stay high. It'll be 3% or higher through this year, and I think it's more likely to be persistent or more persistent than many of the market are expecting in the coming years. You've seen signs of it easing, and I think we will see it ease first a little bit from very, very high levels. Supply chains will become untangled. You've seen shipping rates come down. Semiconductor supplies, which has been a big limiting factors in areas like autos, are slowly increasing. But it'll be more persistent than in the past, and I think higher than the Fed expects. Supply chains are very, very complicated. There's COVID constraints still around the world, particularly in China with the zero COVID policy, and that's going to continue to disrupt supply chains as ports shut down, factories shut down, and there's still unmet demand. But longer term, the pressures that will push up inflation or keep it elevated, in particular, are rents and housing prices and also wages. The labor market is very tight. As I mentioned, there's more job openings than unemployed people. So what companies are going to have to do is they're going to have to raise wages to attract employers, and that's going to drive inflation, and that takes time to filter through. And the housing market is still very strong. There's a lot of unmet demand there and huge demand for apartments, and that's another big component of inflation that takes longer to develop, and that's going to make inflation more persistent over time. So the Fed's going to play a key role in 2022. We expect the Fed to hike 3 to 4 times a year this year and next year, and possibly higher if inflation doesn't come down quickly. The strong economy and higher inflation are pressuring the Fed. One way to look at it is there's an old adage that the Fed's job is to take away the punch bowl just as the party gets started. In other words, what it means is that they don't want the economy to overheat, so they're going to withdraw. Well, they're pretty late to the game right now. Inflation has already exceeded their goal, which is 2% over time. Another goal that the Fed had is maximum employment. We're at or very close to that. So the Fed is going to have to remove that punch bowl, and they may even have to raise rates faster than they expected because they're in a game of catch-up right now. For a long time, they thought inflation was transitory. Well, they retired that word, and inflation exceeded their expectations. So they're going to be raising rates. They've already started tapering, and what that means is that they're going to slow down and eventually eliminate asset purchases. They were buying about $80 billion a month, or 120 treasuries and another $40 billion a month of mortgages, and that's going to end by March. And then sometime this year, they're likely to reduce their balance sheet also. So you're seeing the Fed aggressively react to inflation right now. So one of the risks, though, is that they're going to have to raise rates faster than they expected in order to tamp down inflation. In other words, they underestimated how fast and how sticky inflation will be. The other risk is that they don't raise rates high enough. If you look back 10 years ago, what was considered a neutral rate, which is where it's neither accommodative or tightening to the economy, that used to be 4%. Right now, the Fed has it at 2.5%. Some in the market think it's even lower. Well, if that's not correct, the Fed may not raise rates high enough. We're in a very different environment than we were the past decade, where the main concern was deflation. So those are some of the largest risks for the market this year. So how do markets perform around Fed raising cycles? They hold up fairly well. What really matters is how fast they tighten and how high they tighten. If you look at equities, credit, volatility, rates, they all tend to be a little choppy into a Fed hiking cycle, but then perform well over the next year. What makes it worse is that eventually the Fed ultimately over tightens. So that's the risk there, and then assets prices do poorly.